in inventory and producing a lot and letting this inventory unsold by the end of the period, that may impact the profit or the result for the period. And therefore, the standard is careful in emphasizing the items of expenses that should or should not be allowed to be included in inventory, and also emphasizing the quantity that is allowed to be used in inventory as normal capacity. Every time the actual capacity is lower than the normal capacity, we mentioned that the cost of unused capacity is not going to be distributed or charged to inventory. Instead, is going to be recognized as an expenditure. The reverse is true when we have actual capacity very large compared to the normal capacity. These are by far the theoretical rules governing the inventory expenses and cost allocation. But yet we are going to come to those rules again tomorrow when we see the exercises. Today we start the lecture with discussing IS 41, which is agricultural produce. Yesterday we mentioned specifically that IS 2, so the inventory standard, is not or does not include in its scope 3 different or specific things. The first one was construction contracts. There is a special standard for that, IS 21, construction contracts. The second one was agricultural produce with IS 41, and we're going to talk about that today. And the third thing was the financial instruments that you already covered through 3 different standards in the first part of the course. But previously, when IS2, which is one of the earliest standards that has been introduced, when it previously was introduced, it included also the agricultural produce. But then it was evident that this kind of produce was different from other kinds of inventory. So it deserved to be treated and explained through a specific standard. It is actually a fairly short presentation, fairly short lecture. Maybe you saw the slides. And something else that deserves to be mentioned is that we are going to cover that only theoretically. So no exercises about how to calculate the amount of crops or something. I just want you to know the theoretical concepts, what agricultural produce is and how it is measured. Okay, so just theoretically. Let's start with the learning objectives. First of all, we have to discuss the requirements relating to agricultural produce, which is a special, as we said, a special kind of inventory, if we may consider it that way. Then we will identify the disclosure requirements of IS 41. As you may understand, IS 41 is useful and relevant only to some companies. Probably many companies that you are maybe working now or will work later, or maybe are working for the group project, have nothing to do with agricultural produce. So it is a very specific standard. It only applies to companies that work in this specific sector. And that's why it is relevant only in specific cases. It's good for you to know the rules and to know the terminology, but it's not that you will need to know everything because it is related to every different company. It's not like this with inventory standard. All companies have inventories. Some more, some less, but all of them have to deal with inventories. Agricultural produce is not like this. It's not relevant to all companies, but only to a few of them. So the contents of the lecture today, first of all, we are going to mention which are the requirements for inventories if they fulfill the criteria to be considered agricultural produce. So which kind of inventories are included in the scope of IS 41? And then, what does IS 41 specifically requires to be disclosed in the financial statements and in the notes regarding agricultural produce and its related components? Something that we all have to know, it's 2 different concepts. Sometimes we may mismatch or misassociate them with each other, but they are 2 distinctive things. First, it is the agricultural activity, which is the process or the management of the biological transformation processes and the harvest of the biological assets for sale or conversion into agricultural produce or into additional biological assets. Now you see here that there are two different things. One is agricultural produce, and the other thing is biological assets. They are actually part of two different sections in the balance sheet. Agricultural produce is usually part of what we may consider as inventory for this kind of companies. These are farms by far. And these farms have in their inventory agricultural produce, whereas in their assets, long-term assets or non-current assets, they may have machineries and equipments, but they also have biological assets, which are, let's say, a different kind of inventory for a longer term. Here you have explained what biological produce is. It is that part of the harvesting process or biological transformation process. It's not just crops and harvesting, but also living things that grow in farms, cattle or else. Biological produce can be sold immediately after harvest without any further processing, or can be sold after further processing. So the company may choose what to do with this biological produce. They may further process it or sell it immediately. This depends on the prices in the market and what the company chooses to do, depending on her own incentives to generate profit, which is the best thing or the best solution for the company. The requirements for inventories under the IS 41 are several, and if we may mention, first, agricultural produce at harvest is recognized and measured according to this specific standard. So it is not IS 2, but IS 41 that governs this kind of inventory, if we consider agricultural produce as inventory. Then the rules of measurement, you can see, are pretty different from that of inventory, because agricultural produce shall be measured at fair value less costs to sell at the point of harvest. Now, compared to the inventory, usual or normal inventory that we discussed yesterday, for the inventory, we mentioned that usually we use the cost, either cost of purchases in case of merchandise inventory, or the conversion cost for the manufacturing inventory, finished goods. But with agricultural produce, that is not easy to measure. How can we measure what we spend to grow crops in a field? That is why the standard requires the agricultural produce to be measured at fair value, less cost that I need to spend or I need to do in order to sell this agricultural produce. Now, let me ask you a question. I think that in the first part of the studies, you already discussed about what fair value is. Okay, I want someone maybe that can explain. And I also want to clarify that fair value is not net realizable value. You remember from yesterday, net realizable value, many mismatch them. It's some ambiguity that someone may think it's the same thing, but it's not. So what is fair value? Maybe someone? As we said, you are allowed to make mistakes during the course. Train yourself. It's better to be ready. Okay. What fair value is with your own words. I'm not looking for a definition, which is exactly the same like in the IFRS. What you understand with fair value, because I want to make the distinction with net realizable value. Okay, fair value is market-based value. It is the price that will exist in normal conditions of trading between knowledgeable parties. They know the prices and they agree to enter in this transaction, and the price that is executed in this transaction is the fair value. So under normal conditions in the market. But what is the difference then between fair value and net realizable value? You remember from yesterday that we mentioned net realizable value? It was the difference between selling price less costs until the point of sale for inventory. Which may be the difference, how you understand. Sometimes we may think that's the same thing, and I agree, you may think that. Okay, fair value is a value or a price that is outside the will of the company. It is decided by the market itself, as we previously mentioned. Whereas the net realizable value, being the difference between selling price and less the costs to further process the inventory, is something specific for the company itself. The net realizable value may be the result of having a special agreement with a special customer, with a separate customer, and therefore it is not something that will exist in normal conditions in the market. Thus, the fair value is something that is existing under normal conditions of trading in the market. It does not depend on this specific company and the specific customers that it has. Whereas the net realizable value is something specific for the company. Now, this is more theoretical distinction, but I want you to know that it's not the same thing. When we say net realizable value, we have in mind this specific inventory that this specific company will sell to this specific customer. And probably if this inventory will be sold under normal conditions in the market, that is the fair value, it would be a different price, if you can understand that. So don't mismatch or have any ambiguity on the two different concepts. Now, the IS2 inventory standard mentions only the cost and the net realizable value, but not the fair value. So the fair value is mentioned only in IS41. And as we can see, we can measure agricultural produce fairly easy by referring to this fair value or this market value that you mentioned, but first subtracting or deducting the cost that I need to do to sell this crop or this agricultural produce at the point of harvest. So first of all, keep in mind the difference in the method of computing or accounting for the cost of different inventories. Normal inventory cost, net realizable value, the lower of both of them, whereas IS41 agricultural produce will be measured at fair value, less the necessary costs. Then you see here, when agricultural produce is further processed after harvest, it will be recognized and measured according to IS2 inventories. That is, if we don't sell the agricultural produce at the point of harvest, but we keep and process, and we spend some money to differ the substance or the packaging of this agricultural produce, it will be treated under IS2 inventory. That means that we will accumulate costs that we need in order to change the substance and appearance and packaging of this agricultural produce. So in case you don't sell the agriculture produce in the point of harvest, but you keep to produce and generate something else, you will treat that under IS2 inventory. You remember the example with grapes yesterday? Okay, if we gather grapes and we sell that, that was agricultural produce. But if we gather or harvest, grapes, and we use grapes to produce wine, that was inventory. This is what we are saying here. So at the point of harvest, in case we don't intend to produce something else, it will be part or considered under the scope of IS41. In case we use it to produce something else, it will be under the scope of IS2 inventories. Another thing that we have to remember is that in the case that we make or we use agricultural produce to convert to something else, that is to produce something else, the fair value that we initially considered as a base of valuation and cost recognition for agricultural produce will be augmented with the costs attributable to the further processing of the agricultural produce. That is, if we take the grapes and we use that to produce some wine, the grapes will be valued with fair value plus the additional cost to convert the grapes to wine, whatever the costs are in the plant or in the producing entities. Okay, so these are the rules that we use to measure the cost with agricultural produce at the point of harvest, fair value. In case you need to use this produce to convert to something else, you will add the cost of further processing. And in the moment that you add the cost of further processing, this becomes the IS2, so the inventory standard. No wonder why the authors of the textbook have included IS2 and IS41 in the same chapter. You will find both standards as part of chapter 16, if I'm not wrong. So this is why, because they have connections to each other. So what are the disclosures? That means if I go to the financial statements of these farms or agricultural companies, and I look through the information that they show there, what shall I find? First of all, we have to disclose the change in fair value of biological produce or agricultural produce needs to be disclosed. That means that if we have a change in fair value, remember fair value is the basis for the valuation. If we have a change in the fair value, we have to disclose that. And the change in the fair value will be part of the expenses or income in the current year. So it will be recognized in the result, profit or loss for the current year. For agricultural produce, it's important to determine the fair value at the point of harvest. Again, there is a special standard that guides us in determining the fair value. There are several methods for even assigning or finding out what the fair value is. What the standard here says is that we will be based on the fair value itself. Also, it is important to determine which standard to apply for the recognition and measurement of the assets. Usually the assets of the agricultural companies are machineries, plants, equipment, so the other standards apply to the measurement and recognition of these items. Okay, guidance for group presentation work. This is the last slide. Only if it applies. I don't think that any of your companies have anything to do with, mainly they are groups or holding companies, but I don't think inside those holding companies there is any branches or subsidiary or segment dealing with agriculture. But in case it is, and I missed it, please focus on these 2 points, analyze the biological assets rules of recognition, measurement, and disclosure, and prepare a short summary of information to share with the class. But still, in case if this applies, it is most likely that will not. So just remember, this is a short standard. You have to remember that has different valuation rules. That is fair value less cost of sales. And that is different from inventories, which is based on the cost. And in case net realizable value is lower than the cost, we will be based in the net realizable value. Okay, so this was the IS41. We had an easy start for this morning. I don't know if there are any questions. Something that we need to ask or comment about what we... I think not, okay. Maybe we can continue with the third lecture, let's say, or the third presentation. It is IFRS 4 and 17, which covers the insurance contracts. Actually, this is quite a new topic. Actually, IFRS 17 is not effective yet. IFRS 4, it is effective. It is being used by companies, whereas IFRS 17 is not. It was supposed to be effective starting January 1st, 2022, but then it was further postponed until January 1st, 2023. So it is a complicated standard and requires a lot of preparations that it is costly for many companies to apply. That is why the board decided to postpone it further. Being it a standard not yet effective, that means that when you analyze companies, you will not find this stuff there, but be prepared, because when you go and work after 1 year or 2 years, probably you can work in some insurance companies or banks, and maybe you need to know and apply the standard. Some precaution. IFRS 17, even though covers the insurance contracts, is not applicable by insurance companies only, but by all companies that have a contract that has insurance features or specifics. So IFRS 4 is applicable only for insurance companies, whereas IFRS 17 covers all companies that enter into insurance specific or featured contracts. Okay? Well, we will have also some example with IFRS 17 by the end of the lecture today, but this example, let me tell you, you may find it complex, and you will be right about that. I will not ask in the exam with the full details that I will explain today. I will go in full details only for you to understand and know and be prepared, but for the purposes of the exam, I will not ask you to know everything. By the end of the lecture, I will mention what I would like you to remember and take away from this chapter, okay? So related to the textbook, this is chapter 22. We have jumped from chapter 16, Inventory and Agricultural Produce, to chapter 22, but in the chapters in between, maybe you have already discussed with Professor Bousson. So let's start. What is the learning objectives about insurance contracts? First, we have to understand the concepts of what is an insurance contract in itself. What are the insurance risks and what is an insured event? Usually it is an event that is expected to happen in the future, and we insure the consequences of the event. And we have to be specific what is or what is not an insured event. We have to explain the requirements of IFRS 4, which was the insurance contract's initially issued standard. It was the aim of the board was to cover the gaps and the missing information about insuring contracts, and it was the product of phase 1 of the project of insurance contract. But the aim of the board was to issue a standard that would not make companies make many changes that would be reversed later when a full standard would be issued. So IFRS 4 is modest. It does not cover the measurement of the contracts, but only the disclosure. What goes into the details of measuring contracts and accounting for their consequences, expenses, and income is at IFRS 17. But still, yet this was the intention of the board since the beginning. The insurance contract project had two phases. Phase 1 result was IFRS 4. It was a standard which did not want it to go into unnecessary details that would be reversed later, and therefore it is fairly easy to understand, whereas IFRS 17 is the product of phase 2 of the project, and it is yet to come. It's not effective yet. Many companies have had difficulties in applying this standard, and therefore the board has further postponed it for later. Next, we need to know and understand which are the basic outlines of IFRS 17. As I said, it is a complicated and difficult standard to understand. In case you do not work with insurance companies or banks or other financial institutions that are involved with insurance contracts, sometimes these details are not really familiar. And if we are not familiar with the concepts of the market governing the contracts themselves, we do not know how to account for them. And then by the end of the lecture, we will explain how to apply the concepts of IFRS 17 regarding three very important concepts. One is fulfillment cash flows. The fulfillment cash flows is like what we can consider like the net income that we will have from the contract for whole time span that it will cover. The risk adjustments, being it financial or non-financial risk related to time, value of money, or non-financial risk related to the market itself. And the last one, it is contractual service margin, which is like the earnings or the net result that I will have from a contract. That is money that I receive, less money that I will give to the insured company, represent the contractual service margin that the company needs to allocate into different period when the insurance contract will generate revenues. So these are the basic concepts. They are quite new. This terminology is really specific to the insurance contracts only. It's not like terms, inventory, expenses, income that you find everywhere in other standards. These are only here, only for this standard. And we'll use a simple example or illustration to show what they mean. What is the meaning of these new terms, new concepts? So the contents of today's lecture, first of all, some concepts and definitions. As I said, if you don't work in the sector itself, it is difficult to understand the meaning and the depth and what the insurance contracts are. So first we will cover main concepts and main definitions that we need to know before we go into the details of accounting for them and recognizing in financial statements and then disclosing in the annual report. Next, we were going to explain IFRS 4, which is the existing standard, but it only refers to the insurance companies. If I am not wrong, none of your groups has an insurance company to analyze, right? This year, does any of you have an insurance company or group to analyze in the group project? So again, this is something at least not applicable in the near future. Then we are going to mention IFRS 17, the new standard yet to come, and some illustrative examples that some of them included in the slides are the same that are also part of the textbook. You have seen that what is part of the textbook and explained there in detail, it is included in the slides. And in a certain way, I'm just skipping through them, not really pounding, not really stopping to explain in detail because the textbook has already all the detailed explanations. I need to have some time to focus later in another example that we will see through Excel spreadsheet where we can basically build from the beginning for ourselves all the parts and components of the insurance contracts. So first, what are these two standards related to each other? Both of them, IFRS 4 and 17, define an insurance contract as a contract under which one party accepts significant insurance risk from another party by agreeing to compensate the policyholder if a specified uncertain future event adversely affects the policyholder. Now, this is a definition which may be long to understand, but even though you are not working in an insurance company, you know what insurance policies are, right? We are involved in life insurance or property insurance, car insurance, and we know that basically what they imply is that the company gathers some premium and the promise in return for gathering this premium is to supply the necessary fund to meet the adverse effect in case an event happens in the future. In case the car is broken, in case the property is stolen or destroyed by some specified event, natural causes, fires, floods, and so on. So basically, we know what the insurance contracts cover. They are money that flow from the policyholder to the insurance company that the insurance company will have to meet the needs of the insured party later if this event comes to be true or really happens. This is like a simple explanation about the insurance contracts. Now, what the insurance risk is, this is the risk that is transferred from the holder of a contract to the issuer. That means that if I buy an insurance policy, I'm not the company, I'm an individual. If I buy the insurance policy, I've transferred the risk from me, and I'm the holder of the contract, to the issuer, which is the insurance company. So basically, what the insurance companies do, they gather the risk from the policyholders, and they show their readiness to meet these risks later if specified events come true. Insured event, what we are mentioning again and again, is some event in the future which is uncertain. So there is no certainty that this event will happen, and this is where the insurance companies expect to earn or have a profit because they want to meet that uncertainty for the future. So insured event is this uncertain event in the future that is covered by an insurance contract and creates insurance risk. So here we find the three concepts together: insurance contracts, insured event, and insurance risk. They are all the three there and explained and covered by both standards. Now, what the risk is, of course, these are theoretical explanation about things that probably are not related only to insurance contract. But risk related to the insured event is the essence of an insurance contract, and at least one of the following elements will be uncertain at the inception of the contract. So when we sign the contract, at least one element will be not certain, will be left to be proven or not in the future. Whether an insured event will occur, sometimes it's less likely that will occur, but some kind of insurances are mandatory by law in some countries. For example, car insurance. You cannot go out driving a car without buying a proper insurance to cover for the damages. So probably the insured event will never occur, but still it will be covered in a policy or an insurance contract. When it will occur, if it will happen, we don't know the time it will happen in the future. And the third thing is that we don't know how much the insurer will need to pay. The car damage may be low or may be large, depending on the accident that will happen, but how much the insurer will need to pay, this remains uncertain for the future. Now, based on what we covered so far, we have to identify which of the following are insurance contracts. Compensation in cash or kind to contract holders for losses suffered while traveling. I'm already giving the answers there. That is the example of an insurance contract, obviously, because it is related to some uncertain future event. Remember that there are three elements that may or may not happen in the future, and they are related to the risk of the insurance contract. You see the second example, financial guarantee contract that requires payment. Now, this is the key word. Even if the holder has not insured the loss on the failure of the debtor to make payments when due. Now, this is not an insurance contract because there is no unspecified, uncertain future event. Actually, the payment should be made whatever happens to the debt. So the financial guarantee contract says that we have to pay whatever happens from the debtor. So this is not an insurance contract because it is not an uncertain event. We know that we need to pay in the future. So you see that certainty or uncertainty is a key feature of insurance contract. Another example is a contract that requires specific payments to reimburse the holder for a loss it incurs because a specified debtor fails to make payment when due. Now, this is the example of an insurance contract because it requires payment only when the debtor fails to make payments when they are due. So this is not certain for the future. We are going to pay only if the debtor fails to do so. And this is the example, unlike the previous one that we mentioned, when we had to pay whatever the debtor does that was not insurance contract. We were not uncertain about the future. We were certain that we would pay. But in this case, no. We will pay only if the debtor fails to do so. Another example is a catastrophe bond in which principal interest payments are reduced significantly if a specified triggering event occurs, and this triggering event includes a condition that the issuer of the bond suffers a loss. Again, this is related to some kind of event in the future that is uncertain. If that triggering event happens, this will make the issuer of the bond suffer the loss, and that where the insurance contract comes into the scene. Okay, and that was the last example, I think. Okay. Now, we know that insurance contracts are related to future events that are uncertain about their event of happening or no, about the timing and about the amount of money that will be needed to pay by the insurance companies. Now we go into the details of the two standards themselves. First, IFRS 4 and then IFRS 17. IFRS 4 applies to insurance contracts that an entity has issued and reinsurance contracts that an entity holds. Now, see, IFRS 4 does not relate or is not applied for insurance contracts that an entity holds. Okay, can you understand the difference here? Again, IFRS 4 covers the insurance contracts that an entity issues or reinsurance contracts that are held by the entity. This means that in case you are a producing company or merchandising company and you are holding two insurance contracts, you are not issuing them, you are holding them, this does not make you eligible to apply IFRS 4. IFRS 4 is applied only by companies that have either issued insurance contracts or hold reinsurance contract. Now, what is the second one? What is reinsurance contracts? I'm not sure if I left some notes in the slides, what they are. Okay, what are the reinsurance contracts? Maybe you have heard about them. Maybe you have heard that there are reinsurance companies. The insurance companies themselves, they insure their insurance contracts to third companies, third parties, in case they suffer many, many losses. So what are reinsurance contracts? The insurance companies, whenever they issue the insurance contract, they actually acknowledge that they will go into a very risky contract. They will not know what the future will bring, if the event will occur or not, the timing and the amount. And so the insurance company is not really eager and open to have so much risk, and then they resell this insurance contract, they bundle them together, and they resell to further companies, to third parties. And this is a reinsurance contract. Okay? Now, IFRS 4 applies, obviously, to insurance companies for all the insurance contract they have issued and for the reinsurance contract they hold, because they have transferred the risk of insurance to third parties. This is a very common procedure in the business of insurance companies. You will find no major insurance company that does not resell or transfer or reinsure their contract. They usually transfer to third parties, and sometimes this transfer may have 2 or 3 different phases. But still, we are going to keep it simple and consider only the basic companies or the last companies, insurance companies, that issue insurance contract and then reinsure them. Therefore, they have both. They have issued insurance contract and they hold reinsurance contract. Another thing is that IFRS 4 relates to those financial instruments that are specific. Now, I know that you already covered financial instruments, but there are some specific contracts for financial instruments that have a specific feature that is known as discretionary participation feature. This feature gives them some kind of risk typology, risk characteristics, and that makes them more likely to be considered insurance contract rather than financial instruments. Therefore, IFRS 4 is applied to this specific category of financial instrument. The discretionary participation feature makes it uncertain for the parties of the contract as to which the loss will be bared, from which will be bared the loss. An investment contract, again, that has discretionary participation features, the specific features that we are mentioning, it is also part or included in the scope of IFRS 4. An investment contract, and here it is explained, an investment contract, a financial instrument with these specific features, discretionary participation, is a financial instrument that provides the investor with a contractual right to receive as a supplement to an amount not subject to the discretion of the issuer additional amounts that may be expected to be a significant portion of the total contractual benefits, contractually paid at the discretion of the issuer. That may be regarding timing or regarding the amount of the contract. You can see that this is a special kind of financial instrument or investment when we do not know the return, the timing, or the amount, and that implies a risk for the participants in the contract. And also contractually based on returns from a specified pool of contracts or a type of contract realized or unrealized investment returns on a specified pool of assets that are held by the issuer, or the profit or loss of the entity or fund that issues the contract. So again, this kind of investment, okay, we have a question in the chat. DPF is discretionary participation feature, something that was explained in the previous slide. And that was something that we need to explain before we go on with the insurance contract, because number 3 and number 4 over here actually are not insurance contracts, they are financial instruments with special characteristics, special features. What are these special features? It is explained over here. They are discretionary participation features, and it's 1, 2, 3. Again, this is represented there to make you know that this kind of financial instruments will be considered under IFRS 4, but will not be the scope of our presentation today. We're not going to talk about DPFs. Okay, excluded specifically from IFRS 4 are, first, product warranties issued directly by a manufacturer, dealer, or retailer. Now, if this was not an exclusion, someone may think that if we have product warranties, that is an insurance contract, right? Product warranties relate to a future event for which we don't know if it will happen, the time when it will probably happen, and the amount. So again, if the product warranties are not specifically excluded from IFRS 4, first we may think that, wow, product warranties are insurance contracts. And you may be right, they are the same and they fit and they fulfill all the criteria of definitions. Product warranties relate to future events. You know what product warranties are, right? I'm smiling now. You know what product warranties are? Come on, it's simple. What is a product warranty? It's something very common in the business of big companies, retailing or producing, manufacturing. What is a product warranty? Come on, you are individual customers. you receive warranty for almost everything you purchase. What is a product warranty with simple words so we know what we are talking about? Of course, we may not be involved in DPF, discretionary participation feature financial instruments, because we are not investors, but we are customers and we are involved in product warranties. What are these? What they guarantee against? Okay. Somebody that can speak? Somebody that can say something in the chat? Maybe we have something? No. Damages. Yes, Elisa, thank you. Actually, product warranties are guarantee against damages of the product. In case you have a problem with your laptop, within 6 months or 2 years after you purchase, you can go back to the retailing company and you can exchange it with a new laptop, or you can have it serviced for free. This is a warranty for you as customers. You understand it now? Now, you are not the customer. Put yourself in the place of the company. You are the company that is selling laptops and computers, and you don't know, and you are offering the product warranty with the selling. This is like a byproduct that you are offering. You are selling laptops and you are selling product warranties for free. You are not charging anything for these product warranties, but in your perspective, these product warranties may be considered as insurance contract. Why? Because they fulfill at least one of the three conditions. Product warranty is related to a future event, whether the laptop will go bad or not. You don't know the timing as a company when it will happen, and you don't know how much you need to pay to fix the problem. So if it were in your hands, you would choose to consider that an insurance contract, but the IFRS 4 is very specific, and it says that product warranties is not an insurance contract. Actually, it is considered as it is covered by another standard, and we know that it is part of, again smiling, is part of provisions. You have a specific standard. Have you discussed about provisions in the first part? The standards about provisions is very specific, that you have in your activity, you have to make provisions for product warranties, provisions for contingent events, and so on. So product warranties are not insurance contracts. Why? Not because they do not fulfill the criteria, but because they are already covered in another standard. And that is the standards about the provisions. Please, in your free time, this afternoon is free, by the way, have a look at the provisions standard just to know what it covers. It is very, very useful for many companies, even though it's not part of the IGAP and financial statement analysis course. Have a look to that, because it's really very useful, and you need to know something, even though it is only for the group work project, maybe that you will explain something. Okay. Something else that is excluded from our IFRS 4, so it is not covered with this standard because it is already covered by another standard, is employers' assets and liabilities that are generated under employee benefit plans. Now, what about employee benefit plans? What are these? I know that you have discussed them in the first part of the course. What are employee benefits plans? Never heard about them? Second homework for this afternoon that you are free. First one was read about provisions. The second one, read about employee benefit plans. Now, let me Let me take off my mask for a moment. This is very useful for you to know, employee benefit plans, because when you work somewhere, except for the salary, you receive a whole compensation package that has covered your sometimes transportation costs, and they include maybe shares or stock that will be given to you. This whole compensation package that will be offered to employees like you, really big managers in the future, this is going to be managed by the company. So if they offer you a great compensation package, probably there are assets that the company will manage for you, but altogether with assets, there are the liabilities. What the company is promising to pay you in the contract, it becomes a liability for the company. Okay, so these are employee benefit plans. Of course, you are not accountants, you are managers in the future. You will receive the benefits, you will not make the plans, but still you have to know what is going on. So please read something about employee benefit plans. They are really, really very interesting. Maternity on an example, yes, it is very simplified example. We had a question in the chat. Maternity leave is an example of employee benefit, is a basic example, Claudia, because when I say basic example on the perspective of the company, it's very basic because I know that the maternity leave will last for 1 year and will be paid based on a certain percentage of the salary, your salary. What becomes complicated with employee benefit plans is the uncertain compensation that I need to give to my employees. And this relates, for example, to pension benefits after they leave the company. We will need to pay pension to our employees, and we don't know how long they will live after they leave our company, just to mention one factor. But still, yes, that is a simple example. There are more complicated issues related to employee benefit plans. Something else excluded from IFRS 4 is contractual rights contingent on the future use of a non-financial item. Again, all the items mentioned here are already included in other standards. Financial guarantees into which an entity enters or retains on transferring financial assets and contingent consideration payable or receivable in a business combination. We have a specific standard for business combinations. We have specific standards about warranties and contingent liability and assets. We have specific standards about employee benefit plans. And therefore, these are not going to be included or regulated under IFRS 4. And the last thing is the direct insurance contract that the entity holds, something that I mentioned even before. If you hold insurance contract, this does not mean that you have to apply IFRS 4. You apply IFRS 4 only if you issue insurance contract or reinsure them. Okay? Okay, let's have a short break. Having a look at the question. Now, I'm deciding that probably we'll have for each hour 5 or 10 minutes break, short breaks. Every hour, that would be better than a fairly long break. 5 or 10 minutes break, so. Okay, so before the break, we interrupted our lecture with this question over here. I think that it is fairly easy to answer that because I just mentioned a couple of moments ago that whenever we have product warranties or guarantees, they are not part of IFRS 4. So basically, this entity that sells computers, and I offered that also as an example for you, this is not an insurance contract, but rather it is part of the contingencies and other provisions that we mentioned are not part of insurance contract. Of course, company is accepting significant risks under this contract because we don't know the number of services that we will be required to perform on behalf of our customer, or we don't know the nature of the performing or the repairing that needs to be done. So basically this fulfills and meets the definition of the insurance contract. But as we said, IFRS 4 specifically exclude the product warranties issued by a retailer. So this should fall outside the scope of IFRS 4. Actually, it is part, as we said, of IS 37, which is provisions standard. If the extended warranty had been provided by a third party, for example, a specialist repair firm or a competing manufacturer or retailer, then the exclusion would not apply, and IFRS 4 needs to be applied. That is, the entity A will not apply IFRS 4, but if the services of repairing, that is, the guarantee is transferred to another company, this other company would need to apply IFRS 4, because for that other company that is not a product warranty, that is actually an insurance against a damage, an insurance contract. The warranty obligation in itself would be accounted for in accordance with IS 37, so the provisions. Okay, so that was an answer for our question that we shared before the break. As we said, we also have test questions again and again included in our presentations. Which of the items below is usually excluded from the scope of IFRS 4? Actually, A was included. Financial instruments with discretionary participation feature is part of the instruments and contracts provided to be covered by IFRS 4. Insurance contract that an entity issues is also part of IFRS 4. And C, alternative C, is the correct one. What is not included in the scope of IFRS 4 are the insurance contracts that an entity holds. This is the exact answer. Alternative C. Let's see another test question over here. Again, all these test questions have been previously included in your exams. So it's good to know how the insurance contract will be required and asked from you. If not with calculations, with multiple choices question. Okay, all of the following are excluded from the scope of IFRS 4 except product warranties contracts is excluded. Insurance contract issued by an entity, actually this is not excluded. That means that alternative B is correct. Now, be aware, sometimes for non-native English speakers, like I guess we all are, the multiple choices questions are very tricky, if I may say so. The way they ask the question makes you being confused. For example, look at this question, how it is presented over here. All of the following are excluded except. For a moment, this may become a source of confusion, especially if we are not native English speakers. Okay, so please be careful and watch very carefully to the way the question is composed. Sometimes it may cause confusion. Okay. Let's start with the disclosures required by IFRS 4. As I mentioned before, IFRS 4 does not go into detailed calculation how to recognize and how to account for insurance contract. They just want to make some changes, not deep ones, that will be easily reversed later when IFRS 17 will come into full effect. So basically, IFRS 4 covers only the disclosure issues. This standard requires disclosure of information that identifies and explains the amounts in its financial statements that arise from insurance contract. That means that if you have included in the balance sheet or income statement or comprehensive income statement any item that is related to insurance contract, you have to give some explanation and disclosure in the notes. This part of the income or this part of the liability relate to this part of insurance contract that I am issuing with this third party. Now you see the standard does not go into detail how to account for the contract itself, how to recognize expenses, how to recognize the income, but just how to disclose information and what details you have to put in the notes of the financial statements. Something else that should be disclosed is the accounting policies, recognized assets and liabilities, income and expenses. Again, what I'm saying is that the standard does not impose any restrictions or does not require specific things for companies to do, how to recognize these elements, but only how to disclose them. Companies have full choice how to account for insurance contracts. It's only their disclosure that is regulated with IFRS 4. Again, this was the full intention of the board, to regulate the disclosure, not to regulate the internal recognition and accounting rules for insurance contracts at first. Another thing is that this standard helps user to understand the amount, the timing, and the uncertainty of future cash flows from insurance contracts. Again, remember what we said yesterday. The final objective and purpose of the financial statements and IFRS is to help potential investors understand the situation of the company better before they make an actual investment. So it's for decision making for the investors on their behalf. And that is what is the scope here of IFRS 4. It should be disclosing the timing and the probable liabilities and expenditure that are related to this insurance contract. So when potential investor takes into consideration to invest in this company, they would know what to expect. If this company has already issued some insurance contract, this will be the probable future cash outflows related to this contract. But again, the standard is not saying to the company, you should calculate the cash flows, this and this and this, but just to disclose them, the amount and the timing. The internal valuation rules were left to the discretion and choices of each one company. And all the insurance companies are doing the same right now. They use their own models, their own rules that they have been using all the time. Terms and another detail that should be disclosed is terms and conditions of the insurance contract that may have some important or material effect on the cash flows of the insurer and actual claims compared with previous estimates. So this is the list of disclosures the IFRS 4 imposes on the companies to provide for investors. IFRS 4 has actually other features, other elements that we should mention before we move on. It exempts an insurer temporarily until IFRS 17 is effective, so 2 more years almost, from some requirements of other IFRS standards. That means that if financial instrument standards will require you to account in a certain way, you may have an exemption from IFRS 4 because you are, let's say, in a waiting list to apply IFRS 17. So you are not required to abide to some other IFRS standards, and the most important ones that I may mention are the financial instrument standards. So it provides some relief for these companies. Another thing is that IFRS 4 permits an insurance company to change its accounting policies, but only if the resulting financial statements would be more relevant but no less reliable. Now, this may look like a complicated sentence. You have seen over and over that we mentioned that IFRS are very broad standards and they allow many alternative measurement rules. The company may choose either one rule of valuation or the other. For example, you have mentioned for the long-term assets that you may account for them either through amortized cost or through fair value, but the company may choose between them. But once it has chosen the method, it should not change the method of valuation after 1 year or 2 years. Basically, we have to apply the financial reporting standards in a consistent manner. And this is what IFRS 4 is saying here. You have to apply the valuation rules and accounting rules in a consistent manner unless, so you are allowed only with one exception, if you change the rules for accounting, this will happen only if you provide more accurate and reliable financial statements and financial information. If you change the accounting rules and they do not result in more qualitative financial statements, don't do that. Now, this is very subjective, if you may think, because if you are a manager and you decide to change the accounting rules and you justify this movement with the statement that, oh, I did this because this will result in more qualitative financial statements, this is a very tricky situation. And that is true not only for IFRS 4, but basically for all the international financial reporting standards. They allow you to change the rules only if they produce or give more reliable, more accurate information. Another feature is that IFRS 4 permits the insurers to introduce an accounting policy that would see the insurance liabilities in each period reflected at market interest rates. That is that maybe you can follow the liabilities that are related to the insurance contracts. You can follow the interest rates in the market in order to make their values or their liabilities more updated and to give more reliable information. The last thing is that this standard does not require the insurer to change its accounting policies even if they are excessively prudent. We mentioned something about prudency in accounting or prudent principle in accounting, that is to be very careful whenever we foresee that we will have some expenditure. We have to recognize them in the financial statements. Now, the IFRS 4 does not make it a requirement for the companies to change the accounting rules in this case. Again, all these specific features of IFRS 4, they come from the fact that this is like a temporary standard. It's an interim standard waiting for the big one to come into full effectiveness. That is IFRS 17. Another thing is that IFRS 4 requires or permits, you can see it in both ways, an insurer to unbundle its deposit component, that is a financial instrument element of the contract, from the insurance component when certain conditions are met. That means that if you pay the premium, or if you as a customer pay the premium of an insurance contract and this premium is deposited in the bank, the insurance company may treat the deposit under the financial instrument standard and the liability that arises with you paying the premium under the insurance contract. You may choose to do that. The IFRS 4 allows to unbundle, to detach these two elements from each other. But actually, this is this brings many problems in accounting for two different elements with two different standards. It no longer allows catastrophe and equalizations provisions. Again, the provisions are all covered in IS 37. The provisions requires a liability adequacy test at each reporting date. That is, whatever amount you are reporting as liability under the insurance contracts that you have issued and policyholders have purchased, at each reporting day, that is 31st of December, you have to make a liability adequacy test. Is it enough what you are reporting in the financial statement? Is it actually enough money to pay to the third parties in case these uninsured, unspecified, uncertain events will happen in the future? Actually, this liability adequacy test is not something that accountants can do. Actually, there are specific sectors or specific offices in insurance companies that deal with predicting the adequacy of the amount of the liabilities. Okay, so probably it's not something that we need to go into details here, but it's actuarial services or sciences, people that study how to predict what is a probable value of the liability when many conditions are uncertain. The amount, the time, the number of the incidents that can happen. Okay. So another thing that we need to mention, any questions so far? I know there is a lot of theory and concepts. I'm trying to go slowly today, but if this is too slowly, please let me know. I want to make sure we understand every theoretical component before we jump to the illustrated example. Something about the financial guarantee contracts. As we said, product warranties or product guarantees are not covered by IFRS 4. But this is not a product guarantee, it's a financial guarantee. A financial guarantee, in simple words, is a contract in which you guarantee that if a third party will not pay the liability, you will pay instead of them. With a broad definition, it is what you read there. The issuer will make specified payments to reimburse the holder for a loss it incurs because a specified debtor fails to make payment when due in accordance with the original or modified terms of a debt instrument. To put it simply, financial guarantee means that a company is guaranteeing the debt of some other businesses. If they fail to pay their loan, this company will guarantee the payment. And actually, this could be regarded as insurance contracts if you think of the definition or criteria. They are fully met in this case. Yes. However, IFRS 9, which is financial instruments that you already covered, state that actually these financial guarantee contracts are treated or are covered by IFRS 9. And whatever something is covered by another standard, it will not be double covered by another standard, so it is not causing overlaps. So the insurer can choose to apply either IFRS 9 or IFRS 4 for these specific contracts. Now remember, product warranties or product guarantees are not under IFRS 4 because they are under IS 37 provisions. Whereas financial guarantee, the insurer can choose whether to treat and report them under IFRS 4 or IFRS 9, which covers the financial instruments. Actually, it is the choice of the company itself. This was all about IFRS 4. As I said, there is no rule, there is no example or exercise about IFRS 4. It just has theoretical knowledge. And remember that it only covers the disclosure and details. It does not go into specific rules that the companies should follow to account for the insurance contracts. IFRS 17 does that. IFRS 17, that will come into full effect after 2 years, deals with the accounting for insurance contracts. That means this standard will tell you how much you will recognize as expense, how much you will recognize as income, how much you will report as an asset, and how much you will report as a liability. That is the 4 elements related to the specific activity, which is the insurance contracts. Something else is that the IFRS 17, as I mentioned, is only applicable to the insurance component of the insurance contract. If the insurance contract has some investing features or some financial features, that will be covered by another standard. That is only the insurance component. That is the liability to pay for the damages that may happen in the future. Only this part will be regulated by IFRS 17. Whereas investment components are to be accounted in accordance with IFRS 9, and service components are to be accounted in accordance with IFRS 15. Now, what are investment components? Whenever you pay the premium and the insurance company puts it in a deposit in the bank, that is an investment. To account for investments, you use the financial instrument standard. What is the service component? The service component is when actually a damage happens and the company needs to pay the insured party. This is the service component, and this will be accounted for according to IFRS 15, which is the revenue standard. The revenue standard tells you when to recognize revenue and when to recognize the expenditure that are matched to that part of the revenue. And that is okay, you are receiving the premium for this insurance contract, but this insurance contract covers 3 or 4 years. How will you divide the amount of the premium in these years, and how you will divide the amount of expenditure in these years? Okay, this is something that IFRS 15 says, not IFRS 17. Okay? So what IFRS 17 says specifically about the initial recognition of insurance contracts. Now, IFRS 17 states that there are no more day one profits. So at the initial recognition, you will recognize 0 profit for the insurance contract. Remember that before this standard, what insurance companies are actually currently doing is that whenever they receive a premium on their policies or insurance contracts, they may declare and recognize that a profit since day one. Okay? Why is that? Because IFRS 4 does not exclude that option. IFRS 4 regulates only the disclosures, but not the accounting. When IFRS 17 will come into full effect, it will say that at the day you receive the money of the premium, you will not recognize profits. So no more day one profit. And allow me to expand that a little further. That is consistent with accounting and revenue recognition rules. In accounting, we recognize revenues along the period when we offer a service, okay? And that is true also for insurance contracts. If we receive a premium now, but insurance contract will last for 3 years, it's not fair to recognize the revenue now, but we have to divide and we have to spread this revenue over the 3 years that we will offer the insurance services. And that is the basic idea behind this requirement of IFRS 17. Again, it's not something unusual. It's something that we usually do in financial reporting and accounting. We want to recognize revenues along the period of offering services. That means when the insurance company receives the money of the premium, or that is the moment when you buy the policy and you pay the money, that may be an expense for you, but not for the insurance company. It's not an income. It's not a revenue. It should spread that revenue over the period of generating and offering services. Okay, first thing, no more day one profits. And the second thing is that the entity shall distinguish between two following components that are really important and really specific only for insurance contract. That is, you will not hear them in other standards. The first one is the fulfillment cash flows. What is fulfillment cash flows? Now, cash flows, we all know what they are. Cash flows are money that goes in and out, and usually the company calculates a net cash flow. How much money did I receive, less how much money did I pay? That is the net cash flow that is left for me as a company. Now, the fulfillment cash flow here is basically the same concept, but it takes into consideration, except the money that goes in and out, it takes into account the time value of money. Have you considered or discussed about the time value of money somewhere, anywhere in your past studies? What is time value of money that is taking into consideration by the fulfillment cash flow here? Yes. Perfect. $1 today is worth more than $1 tomorrow. Is that right? Okay. Do we all understand that? That means that if I have $1 today and I put it in the bank, tomorrow I will have more than $1. Not considering the current deposit rates of the banks, but ideally the rule is that with the passing of time, the value of money will increase if I put that in a bank. And when we consider, now what this has to do with what we are saying here. When we consider the insurance companies, the cash flows happen in different moments. I receive the money of the premium, I am the insurance company, okay? I receive the money of the premium now, but I have to pay after 2 years. I cannot simply add the money that I receive now with the money that I'm paying after 2 years. I have to bring them to the same base of valuation by discounting with a discount rate that reflects the time value of money. Now, what are these discount rates? They are provided for you. You should not think how to calculate that. And hopefully in other subjects with finance that you will take, you will learn about the time value of money more and how to calculate the discount rates. But basically what that does is that it brings cash flows from different points in time. It brings under the same rules of valuation, under the same basis. There are some tables with time value of money that we can use, or some financial calculators. You put the time, you put the interest rate of the market, and it will generate the future value or the present value of cash flows. Again, this is not something that I will go into details because I will not require that from you. Maybe you will learn later, or you have learned in your past studies. So first component, fulfillment cash flows. This insurance contract that I'm issuing, how much money I'm receiving as a premium, how much money probably I will pay as liabilities when the insured event probably will happen, and combining them together, taking into consideration the time value of money and probably some other cash outflows that are related to market risk, fluctuations of the market, this will bring me with the fulfillment cash flows. That is the net cash flows that I will have from this contract. In general, every insurance company make a simple calculation in the mind. I'm having so much money from this contract, this is the premium, I will pay this money, okay, this is the money that is left with me. A kind of profit or result from the contract. This is the fulfillment cash flows. And the other component is, again, you will find this only in the IFRS 17, is the contract service margin, CSM. The contract service margin is very simple to calculate because in the initial recognition of the contract, it is equal with the fulfillment cash flows. That is, we calculate contract service margin equal to fulfillment cash flows in the initial issue of the contract. And that is even the reason why we calculate fulfillment cash flows. We may consider the contract service margin we may consider that as a kind of profit, long-term profit, total overall profit from the contract overall. Again, contract service margin, you may consider that as an expected profit from insurance contracts. Okay? Fulfillment cash flows is the net cash flow that will be generated, whereas contract service margin, you may see that as an expected profit from the insurance contract. Is that clear so far? Any questions? If the CSM, contract service margin, is the expected profit, it should be spread and recognized and divided over the years in which I will cover this contract. Remember the rule, no more day one profit? Okay, that means that this profit will be, instead of being recognized at day one at signing the contract, I need to recognize this profit over the years, and this is where things become complicated. This profit is CSM, and I need to divide the CSM over 3, 4, or 5 years. Okay? Let's have some more details about both components. Fulfillment cash flows, that what they are, following the definition of the standard, they are explicit, unbiased, and probability-weighted estimates. That is expected value. Another term here, you know what expected value is, right? Expected value as a general concept. What is expected value? Okay? It has to do with statistics this time, not with finance. You have studied statistics now. What is an expected value? It's not an actual value, actually. It's not a current value. It's expected. Now, this word expected, it seems like a daily word, but in this standard, it has another definition. It has a statistical meaning. Expected value is the weighted. We have some answers in the chat. The most probable value, no, Alessandro, I'm sorry. Actually, if it was the most probable value, it would not be expected. The expected value, actually, it is the weighted against probability of different scenarios. Okay? Anyone remembers? Just a simple explanation in the whiteboard. The optimistic and pessimistic scenario. Of happening or being, should have 40% because in reality we have only 100%, right? Of course, there may be more than 2 scenarios. There may be 10 or 20, and that depends what platform and software you use to calculate the expected value. But according to the optimistic scenario, which has 60% probability to happen, you have revenue and calculating revenues here. Revenue $1,000, and this is the optimistic scenario. If instead this pessimistic thing happens, and this is likely in 40% of the cases, your revenue is only $500. Now, how do we calculate the expected value? Alessandra was proposing that that is the most probable thing to happen. That is most probable is this one scenario here. This is not expected value. Expected value is the sum of the weighted amount between probability of happening and the actual result. That is 60% multiplied by 1,000 plus 40% multiplied by 500. 600 plus $200, $800. Sorry about the calligraphy. $800 is the expected value. You see? Now, the expected value is simply combining together the probability with the outcome here But actually, it is more close to that scenario that has the highest probability of occurring, of happening. You have two results here, 500 and 1000. The expected outcome, it is 800, that is between 500 and 1000, but closer to 1000. Why? Because that is the more likely option. It has the highest probability. Okay, I think that you have already studied this somewhere in math or somewhere, doesn't matter. But this is the expected value. And now the fulfillment cash flows here, they take into consideration this expected value of all the present values of the future cash flows. This requires a lot of planning about the future, minus the present value of the future cash inflows that will arise when the entity fulfills insurance contracts, including a risk adjustment for non-financial risk. This seems like a very long sentence. Now, this fulfillment cash flows includes cash inflows, cash outflows, expected values, time value of money that we mentioned before, and also as a last component at the end, it also has a non-financial risk that reflects the fluctuation of the market usually. It's not deriving from the inner features of the insurance contract, but it's deriving and coming from the features of the market. All this sentence here is translated in the exercise that we will see in a certain table with step-by-step calculation. But for the moment, remember, future cash flows combines together cash inflows, cash outflows related to the contract, combined with expected values, time value of money as well. And also, if there is any non-financial risk, it should be included there as well. Okay? Another thing about fulfillment cash flows is that we may disaggregate and we may detail into these components here. Estimates of future cash flows. So first thing that I have to do with an insurance contract is that I have to forecast and I have to estimate how much I will pay for this insurance contract. What are these probabilities over here? If I have issued a contract, let's assume for a car insurance for an individual who is not a risky individual, he drives slowly, he is a very careful individual. In this case, I will estimate very low future cash flows. It is very less likely that will happen any incident or accident to this person. Whereas if we issue a car insurance to another individual who drives fast, and also it's not related to the individual specifics, to an individual whose job place is very far away from his home and he has to drive a lot every day, then the probability of something happening in the street is really high. That is, we estimate the future cash flows, and this depends on specific of each contract that we issue. Actually, the standard requires the companies to combine contracts with similar features together. That is, contracts issued to similar customers or to similar regions with similar characteristics, geographic regions, and so on. That is, first of all, we estimate probably how much will we pay for this contract, which are the future cash flows for this contract. And then the second step is to adjust these future cash flows to reflect the time value of money. This is something that I mentioned before. We discount the future cash flows that will happen in the future. We discount and bring them to the present. How do we do that? Again, there are special tables that we use or financial calculators. In case of our exercises, I will tell you how to do that. I will not make you open tables and use financial calculators, but the data in the exercise will tell you that, look, the present value of this cash flow is this much, okay? Another step is to adjust for the non-financial risk. Now, again, the non-financial risk is uncertainty about the timing and amount of the cash flow, and this relates to the general market. It should be considered as a compensation that is required for bearing the uncertainty. These three are elements that should be included in the calculation of fulfillment cash flow. Remember, step 1, forecast or estimate how much you will pay. Step 2, bring the future cash flows to the present by discounting them. Step 3, include a non-financial risk element related to the market, timing, amount. And that is also something that usually is not done by accountants or managers, but by actuarial employees that work in this special sector that deal with forecasting and foretelling many things for the future. It represents, as we said, the probable gain from the contract, if we have a gain, because some contracts may be onerous contracts that we will not actually have a gain from, we will have losses from them. And how to account for the onerous contracts we will mention later. Now, the second component that the IFRS 17 requires you to calculate and disclose is the contractual service margin. Contractual service margin represents what we said, the unearned profit that the entity will recognize as profit as it provides services under the insurance contracts. Again, remember, the standard does not allow to recognize profit in one step, in one day one of receiving the premium, but instead to distribute and to allocate this profit over the time span of the contract. It serves, as we said, to not recognize a profit on initial recognition, and IFRS 17 requires that the entity recognizes profit as it delivers the insurance services rather than when it receives premiums, especially when speaking about long-term contracts. Usually contracts such as car insurance that I mentioned are a short-term contract up to 12 months. And in these cases, it's not difficult to calculate the future cash flows and to bring them to the present because we are all within 12 months or 1 year. The problem arises with long-term contracts that span 3 or 4 or 5 years. These contracts may relate to different projects that the companies are undertaking. And this is the case when the biggest problems arises and complexities in calculating the necessary details. Okay? The subsequent measurement. Any questions so far? It's complicated. Are you tired, or we can have some more time and then have a break? I was thinking to cover some more material and then having the break. Let me summarize what we have said so far. Initial recognition. That is the moment when you offer and sell the insurance contract. That is the moment when you receive the money of the premium from the insurance holder. The premium, insurance contract premium, do you know what that is? What you pay when you are insured against something. The premium is received from the company, the insurance company. Now, this is the initial recognition. In the initial recognition, you have to calculate two different things: fulfillment cash flows, contractual service margin. Fulfillment cash flows, 3 elements or 3 steps. Future cash flows, bring them to the present, include non-financial risk element. Contractual service margin at the initial recognition is equal to the fulfillment cash flow. Everything is simple. Now, what about later? This is the moment that I receive the premium. But what about the end of the year or after 1 year? How will I measure the contract? The long-term contracts have to be depreciated and have to be interest accrued on them. So this is where complexity really arises. At the subsequent measurement, we need to recognize interest that is accumulated on the carrying amounts of the present value of future cash flows and the contractual service margin. On the other hand, the contractual service margin is amortized in profit or loss over the contract term. Let me explain this sentence here. Remember the contract service margin? What did that represent? Contract service margin. What was that? What did that represent? while I was saying and explaining what they represented, I saw a couple of you taking notes, and I was really hoping that you would answer right now. What? Mm-hmm. Yes, Claudia, that is profit for us. Claudia is answering unearned profit, and that is really okay. That is the expected profit for us. Contractual service margin is the total expected profit for whole the time span of the contract. If we call that unearned profit, that it's okay, because in accounting, unearned profits are liabilities, and we recognize that on the liabilities side of the balance sheet. Now, when we say that the CSM is amortized, that means that this expected profit is divided into parts to be recognized as profit over the years. If CSM is 100 euro, then I recognize 50 euro as profit in the first year and 50 euro as profit in the second year. That is the meaning of amortizing the CSM. Don't be surprised by the word amortization. Amortization is simply the allocation of an amount over years. You explained the concept of depreciation, amortization, and so on, okay? And you mentioned that that is actually not meaning that the asset is being depleted or used or consumed. No, in accounting, amortization is simply the division of costs or profits along the years. We do the same with CSM. This is the expected profit for many years. We divide that year by year. We do that. That is a consistent manner that is provided for in the standard. At the end of each reporting period, the carrying amount of a group of insurance contracts shall be the sum of the liability for the remaining period, comprising the fulfillment cash flows related to future service and the CSM at that date, and also the liability for incurred claims comprising the fulfillment cash flows related to past service. That is, what is the liability for the remaining years? It's still in the amount of CSM. Remember, contract service margin represents an earned profit that is a liability that I may have to incur in the future if the event happens, or if it doesn't happen, that is my profit. I will recognize it as a profit. So either way, CSM will either be paid to the other party if the uncertain event occurs to pay to insure to the insured party, or if it doesn't happen, I will recognize that as a profit for the current year. Okay, let's continue. Whether what we'll recognize in the profit and loss statement, we will recognize insurance revenue and insurance service expense. First of all, in the profit and loss statement, we will recognize the insurance revenue, remember, as the reduction in the amount of contract service margin. Again, contract service margin represents the total profit. We amortize that year by year. The year in which, or the amount in which we recognize in the current year, that is the revenue from the contract. Again, insurance revenue is the amount of the decrease in CSM. That is the total profit. If we decrease the total profit, that means that that is the revenue for the current year that we are preparing financial statements. But the insurance contracts do not only have revenues, they also have expenses. The first item of expenses is insurance service expenses. As the name implies, this happens usually if we have an increase in liabilities for incurred claims. To put it simply, if the insured event occurs, this means what will I need to pay to the third party? If the car accident happens, how much need I pay to that person? This is the insurance service expenses. Sometimes it may be zero, yes, when nothing happens, you don't have to pay anything, okay? Instead, you have insurance revenue and zero insurance service expenses. for one contract, okay? But considering all the contracts that are issued by an insurance company, usually there are thousands or hundred thousands of contracts issued by a single company. In total, you always will have insurance service expenses. One or the other will make a car accident. One or the other house will go into fire or will be destroyed. So you need to pay something. Whatever you pay to meet for the obligations of the insurance contract is the insurance service expenses. Is that clear? I mean, can you depict in your own mind what happens? Every year, I will recognize the revenue by amortizing the CSM. I will see how much I need to pay for the current events that have occurred, that is the service expenses for the insurance, but we have another component, and that is the finance, income or expenses. The finance happens because we have considered the cash flows discounted, or we have taken into account the time value of money. Actually, if we do not take into account the discounted value of cash flows, or if we do not take into account the time value of money, we would not have insurance finance, income or expense. Again, this is to account for the effect of time value of money or the effect of financial risk. How do we calculate the insurance finance income or expenses? That depends on the data that we are provided. Usually we are told that, look, the medium or average interest rate in the market is 8% or 10%. Now you calculate yourself, if you put this money in the bank with 10%, how much you would have gained or earned after 1 year. And this is a finance income as a component of this insurance contract. On the other hand, we also have finance interest expenses. So again, in the profit and loss statement, there are three items to recognize insurance revenue. This is the decrease in the amount of CSM by amortization. The second item is insurance service expenses related to the current actual claims for the events that have actually been incurred. And the third component is the finance component, insurance finance income or expenses that this is related to how the interest rates have evolved during a year. We will look later at the three components in an example. Actually, the IFRS 17 not only goes into details about how to account for the for the insurance contract, but also guides what to disclose, what elements and details to disclose about the insurance contract. An entity shall disclose the amounts recognized in financial statements, the significant judgments, the nature and extent of risks from the insurance contract. Okay, we have a break before we cover this illustration. A short break, 5 or 10 minutes, and then we will see this illustration to put into practice whatever we discussed. So, let's see what we have here. This is the usual way of representing the information related to an insurance contract. Of course, you can have other ways of displaying information, but this is the ordinary way you are going to expect the data related to insurance contracts being presented to you. Okay? Now, I know that the solution of this example is on the slides and it is also on the textbook, but please try to understand what's going on because later we are going to solve a very similar example through Excel, okay? So please try to focus and understand all the steps, even though it's already solved in the slides. Now, you see all the pieces of information that you read there, try to process and understand what they represent, following the model that we mentioned a couple of minutes ago. So we have an insurance company, it issues 100 insurance contracts. They are considered to be one portfolio. Now, IFRS 17 allows you to bundle similar contracts together because otherwise you cannot manage them. You may have thousands. So you bundle similar contracts together. Life insurance, car insurance, property insurance, customer sectors, regional geographic areas, and so on. The coverage period is 2 years only. This is very simple. It's very simplified just for you to understand. The premium, €500, is paid upfront. Now, this premium is related to the bundle of contracts, not only to one contract, okay? The premium, again, is the amount of money that the insurance company receives when it issues an insurance contract. Now, in your mind, speaking with the language of IFRS 17, in your mind, you make a parallelization. Premium is cash inflow, okay? So again, the language you have to comply, or you have to make it similar to the language of the insurance contract standard, IFRS 17. Premium here is cash inflow. Another thing is that on initial recognition, the expected annual cash outflow will be €200 per year. Now, stop here. This cash outflow, with very simple words, is insurance claims. Whenever a damage happens, there are claims that we have to pay. So, cash outflows are insurance claims. And you also notice something else. At a discount rate of 10%, the present value, usually the present value is represented with these two symbols, PV, present value, of the cash outflows is 347. That is, I am expected to pay, as a company, the insurance claims that I need to pay is 200 in the first year and 200 in the second year. But if I take these cash outflows in the course of 2 years and discount them to the present, this means that it is equal with 347. Again, you see something that you are not required to discount for yourself the cash flows. This is something that is considered to have been studied somewhere else. The data, the exercise tells you directly that these cash outflows, €200 per year, when discounted to the present with a 10% discount rate, they mean €347. How do we do the calculation? It's not very difficult. For those interested, I can show later. Also, there are tables, there are calculators. It's something simple. I will not require you to do that in the exam. Also, another piece of information, the risk adjustment for non-financial risk is €50. Remember, this risk adjustment is required to be included in the calculation of fulfillment cash flows according to IFRS 17. And here we have the piece of information. The real problem in reality is not how to combine this data to calculate free cash flows and CSM, contract service margin. The real problem in reality, when you work in a company, is how to come up with these figures over there. How do you know that the non-financial risk is €50? How do you know that the insurance claims are going to be €200 each year? Okay, this is the real problem. This is the real difficulty. But again, that is something that is being provided and calculated by actuarial services in a company, insurance companies. Having this information, how do we account for the insurance contract? Remember and write down, there are 3 moments that we have different values to account for in insurance contract. The first moment is the initial recognition before receiving the premium. The second moment is after receiving the contract premium. And the third and the most complicated of all is the end of the accounting year, when I have to recognize what part of the contract is revenue and what part is expenditure, and to prepare the amounts for the profit and loss statement. Let's start with the first moment, that is the moment of initial recognition. As the standard implies, first thing that we need to do is to calculate the fulfillment cash flows. Fulfillment cash flows, remember, involve three steps. Let's remember them together. Foretell or estimate the future cash flows. Second, bring them to the present. Third, include non-financial risk cash flows. Let's start with the future cash flows and bring them to the present. Now, this is a present value of future cash inflows. Actually, in other words, in simple words, put that in brackets over there, this is the premium of the contract. This is money that the company is receiving now. As it is receiving now, it is the same amount, not necessary to be discounted. 500 euro to the present is the same amount. Whereas the present value of future cash outflows was actually calculated in the exercise and readily available to you. It is 347. Again, actually, this is a present value of two future cash outflows. I'm expected to pay 200 in the first year and 200 in the second year, but when I discount them to the present, that represents 347 euro. Okay? Now again, you are the company, and remember, or act like you are the owner of the company and you are making some calculations in your mind. You are thinking, regarding this bundle of contracts, I'm receiving 500 euro and I'm expected to pay 347. What is the net value of future cash outflows or inflows? It's 153. So basically what you do in your mind is what you are getting, what you are paying, the difference is the net present value of future cash flows. But be careful, this is not all you need to do. That's not all your liabilities, that all you owe. You have to take into account as well the non-financial risk. That is, to put it simply, we have assumed that this 200 euro will be paid at the end of the first year and at the end of the second year. But how and why will it happen if this payment time will not be at the end of the year, but will be at the middle of the year? Now, to account for the uncertainty about the timing and also the amounts, we include a non-financial risk component, which is 50 euro. How did we come up with that figure? Again, this is not something that accountants do, but the one that foresee the effects of financial and insurance contracts, actual services. And they say that, look, for this kind of contract, the non-financial risk is very modest. It's only 50 euro. And we say, okay, minus 50. The fulfillment cash flows, the first component that is required by IFRS 17 is over there. 103 euros. Again, how much money I will receive, how much money I will pay, discounted, and considering also an uncertainty factor, non-financial risk, 50 euro. 103 is the fulfillment cash flows. Now remember what this represented in simple words? Fulfillment cash flows represent with simple words. Who remembers? No one? This is like the net result that I'm waiting or I'm expecting to have from the contract overall. Now, that's why I ask you to put your mind and think logically about that. This means that this is the amount of money that the company is expecting to be net or to be left to her or to be left with I will have 500 euro, I will need to pay 347 and then 50 euro for non-financial risk. How much am I left with? 103. The fulfillment cash flows at the initial recognition will be equal with CSM. In order for the insurance contract on initial recognition to be zero, remember the rule of IFRS 17? No day one profit. That means that when I compare fulfillment cash flows and CSM, they should compensate and net off each other. If I'm expecting 103 euro as a profit, that is my liability as well. So CSM is going to be minus that amount, okay? So again, we calculate the fulfillment cash flows as we previously described, and then in order to have the initial value of insurance contract zero, no profit at day one, remember? We need to recognize the contractual service margin at exactly the same amount as fulfillment cash flows, but with a minus, so they net off each other. And I have zero result from this contract at the beginning. So again, what we do at the initial recognition, we calculate the fulfillment cash flow and we assign the value of contract service margin the same as the fulfillment cash flows, okay? This is before I receive the premium. Write down the CSM is 103 euro. That is something to be remembered. And we jump to the other moment in the life of the contract. That is, and here is the explanation what each of them is. What if we receive the payment? Present value, we have received the premium. After day one, after receiving the premium. The present value of future cash inflows now is zero. Why is zero now? Because I've already received 500 euro. I'm not receiving any more money in the future. This is day one after cash payment is received, after receiving the premium. Instead, the present value of future cash outflows, it's the same. I'm still expected to pay 200 euros each year, which discounted in the present means there are 347 euro. Okay? Again, the net present is the difference between both. After I have received my premium, the net present value is negative, because I'm just expecting no more receiving of money now, but only payment of claim insurance. And also the risk adjustment is the same for non-financial risk, 50 euro. That makes the amount of fulfillment cash flows 397. Now remember, after receiving the premium, the fulfillment cash flows represent the total expenses of the insurance contract. This is what I'm expected to pay for this contract in the future. 397 divided into two parts. The future cash outflows in the form of claims, insurance claims, 347, and non-financial risk, 50 euro. Okay? Now remember that the contractual service margin was 103, okay? Minus, with a minus in that. And if you add them together, the insurance contract on initial recognition, that is the liability that you have to show in the financial statements, is 500 euro. But why did you do this, all these calculations? Somebody may ask. That was simple. I know, I'm receiving 500 euro. This is my liability, 500 euro. Why did we do all this stuff over here? Remember, IFRS 17 requires you to divide the amount of liability into two components: fulfillment cash flows, contract service margin. And here you have that. This 500 amount is divided into fulfillment cash flows, 397, and CSM, 103. What do they represent, both of them? Once again, my liability is 500, but 397 is what I'm really expected to pay. The rest, 103, is my profit from this insurance contract, okay? So again, basically the accounting entry is the same. I will debit cash account for receiving 500 euro, and I will credit a liability account, in this case insurance contracts, but behind the scenes, after that, I need to make many calculations as required by the standard, because I need to divide the amount of the insurance contract liability into two components: fulfillment cash flows and contractual service margin. And this is why we make all those calculations over there. Any questions so far? Okay, this is the easiest part. What really is complicated, and I'm not going through that, I'm leaving for you to read for yourself if you like. This is not, it's an optional part of the course. It's not required for the exam. But I know that you are very eager to learn new things and will, of course, read it. The more complicated stuff is how to measure the revenue and expenses from the contract. That involves a lot of things. That involves interest to be accrued. That involves amortization of contract service margin. I'm going through the slides very quickly, following the steps over here. At end of year one, what do we have? We have present value of future cash inflows, 0 again. We have present value of future cash outflows, 182. They are all calculated over here. This is the initial balance, 347 of cash outflows. First of all, we accumulate the interest 10% on that. Remember the present value of the cash outflows, that is 347 multiplied by 10%. We deduct, this is the interest expense on the liability to be accounted in the profit and loss statement. So the initial amount, we deduct the decrease related to the time value of money, and then we also deduct, you see here, one figure of 200 euro. This is the actual payment that we have made. Remember that we need to pay 200 euro each year. So minus 200, we are left with this figure of 182. Okay? And this is what is represented over here. The risk adjustment for non-financial risk was 50 for 2 years. We just divided that in two. No time value of money there, so no complication at all. And the problem is that contractual service margin. Remember that I need to accrue interest first step and to amortize it second step. So we start with 103 euro. Then we accumulate the interest over here. The interest is always 10%. And after we add this interest, we are left with 113. We amortize with the straight line method, very simple, simply dividing it by 2. And we are left with 57.5. Now, what is each of this figure? The insurance contract, the liability in the balance sheet will show 263.5. Whereas the income, the insurance revenue, will be 56.5. Sorry, will be 103 minus 56.5, the decrease in amount of contract service margin. And we have the contract expenditure related to the finance component, equal with the 10% that you see over here. Another expenditure is the service component, which is the half of the risk adjustment. So all the calculations here, of course, they are also in the textbook. This is fully optional for you, but they represent the income, revenue, expenditure, and they help us to calculate the insurance contract on end of year one. And of course, these are summarized the effects on profit and loss, insurance revenue, the decrease in contract service margin, insurance finance expenses, and net effect, which should, by the way, you have a way to control your calculations, if you are right or not, correct or not. The net effect of year one, the difference between revenue and expenses, should be reconciled with a change of the insurance contract in the statement of financial position. The initial value less the payments, 200, should be equal with the net effect. Okay, then we continue, of course, with year 2, the same calculations. I'm not taking more time to go into that. You can finish reading. I think that it's up the time. You can finish reading really very quickly by the end of this lecture some important points of similarities and differences between two standards. We have a question. Yes, that's a fair question, actually. We won't be required to account. You won't be required to prepare the schedule that I just showed you. You won't be required to do that, but you need to know, however, how to calculate fulfillment cash flows and contract service margin, probably by some multiple choice question. That means that it will not be an exercise in which I will require you calculate this and this, but probably it will be a multiple choice question. For example, the amount of cash outflows is this one and cash inflows this one. The amount of contract service margin is A, B, C, and D. So basically, you need to know the calculations only for initial recognition and the recognition after receiving the premium, not at the end of years. That is complicated. I will not ask you to go into that. Okay. So a couple of words about the two standards. After all, why is IFRS 17 replacing IFRS 4? Remember that financial reporting standards are established in order to have a common accounting language, so business and accounts can be understood and compared, as we said, from one company to the other, between industries and so on. IFRS 4 explains how to disclose information from insurance contracts, but there are too many issues with that standard to make that a good comparison between insurance companies, and therefore it became the phase 2 of the board regarding insurance contracts, the introduction of a new standard, IFRS 17, which is, as we said, yet to come. Of course, there is nothing wrong with IFRS 4. There are some pitfalls and disadvantages. First of all, it was introduced in 2004. It was, since the beginning, it was meant to be an interim standard. It was not the final solution for this sector, okay? So there were limited changes introduced to existing insurance accounting practices. Insurance companies were still able to measure similar insurance contracts with different accounting policies. As we repeatedly said this morning, this contract didn't go into details of accounting and measuring the insurance contracts. Actually, what was observed is that these practices evolved based on specific insurance contracts in a specific country, which also resulted into deviations from one country to the other and between accounting models, and actually brought a limited comparability, not increased comparability as expected and desired. How does IFRS 17 helps with that? First of all, it requires companies to measure on insurance contracts on updated estimates and assumptions that reflect timing of cash flows. You saw that the time value of money is included there. Non-financial risk that reflects the uncertainty of the timing of paying the insurance claims is also included there. So actually, this is an evolution, an improvement of the regulation of insurance contracts. Also, insurers need to indicate the expected and earned, as we said, profit. They do not recognize profit in day one, but they recognize the contract service margin, which is the expected profit over the life of the contract. And this is why they calculate this amount. This is in line with other industries. For example, a factory generates the profit only when it delivers the goods and sells inventories, not when it produces or not when it receives an order from customers. That would seem odd and strange. If we recognize revenue when the customers makes the order, that is the same as recognizing earnings on insurance contracts when receiving the premium from customers. So this is something that needed to be regulated in order to be aligned with other regulations in other industries. And this information will make it easier, hopefully, to evaluate performance of insurers against each other. There are also some pitfalls or disadvantages of IFRS 17. Of course, nothing is all rosy and all good. There are always problems with everything. It will cost a lot of money to implement. Actually, the data needs to be administered on lower level, on very identified and specific contract. That means that the insurance companies need to update their information systems to keep more detailed information about each contract. And this is a lot of money for these companies. And this is why they have lobbied to postpone the implementation of this standard. Another potential issue is principle-based. The principles are the same among insurance companies, but still everyone can make their own assumptions and decide how exactly to measure insurance contract. So again, exact comparison, final ultimate comparison, probably will not be possible yet. Main differences: comparability of insurers, transparency and quality of investor information, confidence and cost of capital. The first one, comparability of insurers, IFRS 4 was put together in a fairly compact time frame, just ahead of the EU adoption of IFRS standards. So it was not meant to cover every detail. It aimed for minimum rather than maximum harmonization. Under IFRS 4, companies could therefore carry on using national standards of recognizing and measuring the insurance contracts. And this made comparability extremely tough, which is never good for investors, as we said. Now, what IFRS 17 aims to do is to ensure companies across all IFRS jurisdiction to apply consistent accounting for all insurance contracts, regardless of products. Another thing is the transparency and quality of investor information. We can never emphasize enough the importance that IFRS have for the investing opportunity and analysis and interpretation. Now, IFRS 17 looks to equip investors and to give them better information how each of the companies create their value, how much money do they generate from premiums, how much money they are expected to pay, and what is left. That means the expected profit from each of the contract. Combining current measurement of future cash flows with recognition of profit over the period, this is what really provides the new standard, IFRS 17. Also, presenting insurance service results separately from insurance finance income or expenses. You saw for yourself in the calculations that the expenditure related to the offering of services were recognized in a different item from the income or expenses related to the finance component of administering a contract, requiring, on the other hand, an entity to make an accounting policy choice of whether to recognize all insurance finance income or expenses in profit or loss in other comprehensive income. The third problem that we need to mention is the confidence. Greater transparency, of course, is always great. Some of the largest insurers may also see that their cost of capital may reduce as a result, because the more qualitative, the higher quality the information you offer, the easier is for the investors and creditors to access the capital of the company, and the cost of the capital actually decreases. You may see that as a big cost to implement a new standard, but that increases the quality of the information, and that attracts a lot of potential investors and creditors. And that means in the long run, in the long term, a decrease in the cost of the capital. Challenges, of course, we mentioned them many times, requires not only accounting change, but requires changes in the organization of the work within the insurance companies, implementation of updated information systems, and so on. Technical expertise, many insurance companies are expected to be consulted from outside experts because the technicality and sophisticity is really high regarding this standard. This is the summarized comparison between the two standards. You can have a look for yourself. Of course, there are some other test questions. We may go through them for 2 minutes only. We have time. Another test question that we have here regards the components of the contract. Which of the items below will be amortized and recognized in the profit and loss statement? CSM, fulfillment cash flows, discount rate, insurance premium. Which one will be amortized and will be recognized in the profit for the time span of the contract? Is easy. A, yes. Contractual service margin, good. Have I posted the answers for these questions? I think. Okay. The second test question here. According to the requirements of IFRS 17, at the inception, the initial moment of contract, the entity should not. Again, A, should not recognize profit in the first day. Okay. According to the requirements of IFRS 17, the entity will accrue interest on the contract service margin, accrue interest on future cash outflows, accrue interest on the non-financial risk adjustment, A and B, or A and C? A and B, we accrue interest or use the time value of money concept, both on contract service margin before we amortize that, and of course in the future cash outflows because we discount them to the present. Okay, according to the requirements of IFRS 17, the entity will amortize the future cash inflows, amortize the calculated contract service margin, the non-financial risk adjustment. Actually, we know that the future cash inflows are not going to be amortized. They are just received at the initial moment, and that's it with them. B and C. That is the correct answer. Okay, thank you for everybody who has been also answering in the chat. Okay. Which of the following is not a profit and loss item? Insurance revenue, insurance premium, insurance service expenses, insurance finance income and expense. Okay, I'm waiting for you on that. Which one is not a profit and loss? I'm waiting from you because this is very simple. Huh? Something that I repeatedly said this morning. Maybe 6 or 7 times I said that. So which one is? Okay, this makes me think that I wasn't effective at all for these 3 hours that I've been explaining. Again? This is like the basic thing that you should take away from these 3 hours. When you go out after some minutes, this is something that should be here. B, insurance premium. You should never include that in profit or loss. No day one profit. No day one profit. That's a very beautiful expression. That means when you receive money, that's not a revenue for you. Okay? Okay. And it's a summary over here, which you can go through yourself. I see that this is not effective anymore. Okay. So as I said, we'll have to go through an illustration. Of course, the Excel that we are going to prepare right now is going to be uploaded on Moodle later, but still try to keep your own notes for further references. Have a look at the data, please. An entity issues 100 insurance contracts, coverage period 3 years. This period starts when the insurance contracts are issued, so beginning of year 1, end of year 3. The entity expects to receive premiums equal to cash units 900 immediately after initial recognition. That is, let's assume 1st of January at year 1. Therefore, the estimate of the present value of the future cash inflows is exactly the amount of money that I'm receiving. Why? Because I'm receiving them today. Discounted to the present, they are the same amount. Whereas we estimate.
We can't see the Excel.
Oh, sorry. Thank you. Okay, thank you. I'm sorry. Now it's okay, I think. We still have time to go through the information. Now, regarding the cash outflows, we expect to pay every year 200 cash units. That means that in total for the 3 years, that is 600 cash units. That means that if I discount them to the present using a discount factor of 5%, where do I find this 5% and not 10%? It doesn't matter in this moment. This is depending on the market rates that are currently going on and so on, but this is already provided for you. You should not think about that. So if I discount 3 payments of 200 cash units to the present with 5% discount rate, we will receive a present value of 545. Again, this is based on the discount factors and tables that exist for this reason. The final piece of information, the risk adjustment for non-financial risk, so the uncertainty that I have regarding the timing, maybe I will pay these 200 cash units not exactly at the end of year 1, 2, and 3, but somewhere in the middle and things like this. This is considered to be overall for 100 contracts for 3 years. This is expected to be 120 cash units. Now, you are required to account for the contract at the initial recognition, moment 1, moment 2, the initial recognition after receiving the premium, and the subsequent recognition at the end of year 1, year 2, year 3. As I said,